Hey everyone, and welcome back to the channel. Today, we're diving deep into a revolutionary way of thinking about investing. A strategy that's all about finding companies that don't just grow, but explode with potential. We're talking about Mohnish Pabrai's Spawner Framework. Visual, title card. The Pabrai Spawner Framework, Investing for Explosive Growth. So what exactly is a spawner? Imagine a company that's like a biological spawner, constantly creating and nurturing new businesses within itself. This isn't your typical value investing, where you look for cheap stocks today. This is about finding companies with a DNA to keep creating new growth engines, year after year for decades. Visual, animation of a seed sprouting and growing multiple new plants. On-screen text. Spawner Framework, Beyond Traditional Value Investing. The whole idea is that these spawns, these new ventures, continuously extend the company's growth runway. This gives us investors a really interesting payoff profile, a concentrated portfolio, maybe 5 to 10 stocks. The magic here is that the massive, potentially unlimited upside from a few huge successes can mathematically cover the losses from the many ventures that just don't pan out. It's all about asymmetric payoffs. Visual, a graph showing a few extremely high spikes and many small dips. On-screen text. Asymmetric payoff. Big wins cover small losses. Now, valuing these companies is different. We're not just looking at current profits or book value. We're trying to quantify something much harder: the company's culture and its ability to generate future value. Think about Amazon. They invested heavily in AWS, which wasn't obvious at first. But that one moonshot paid off in a way that dwarfed everything else. This means we have to be willing to pay a premium for this optionality, the potential for incredible future growth, even if it's uncertain today. Visual, split screen. Left, traditional balance sheet. Right, a more abstract visualization representing potential and future growth. Section 1. What is Spawner DNA? Visual, section title. Spawner DNA, the secret sauce. So what makes a company a spawner? It's all about deeply ingrained DNA to constantly experiment and incubate new businesses. This isn't a management fad, it's a core part of their identity. And a crucial part of this DNA is the acceptance of failure. Visual, on-screen text. Acceptance of failure, the key to innovation. Think about Jeff Bezos's Day One philosophy. Experiment patiently, accept failures, plant seeds, protect saplings, and double down when you see customer delight. This is the spawner mindset. They make small, manageable bets, so a failure doesn't sink the whole ship. It's a brilliant way to manage risk and maximize exposure to radical innovation, all while protecting their core business. Visual, a graphic showing small bets being placed on different ventures, with some failing and others flourishing. On-screen text. Small bets, big potential. This is why we see older, massive companies sometimes struggle. The bureaucracy, the entropy, as they call it, can kill that experimental culture. Companies like General Electric or IBM, despite their long histories, lost that crucial spawning DNA. Visual, images of GE and IBM logos, perhaps with a fading effect. On-screen text. Beware of bureaucracy. And who leads these spawners? Great capital allocators. People like Jeff Bezos or Warren Buffett. They know how to reinvest the profits from their core business, their free cash flow, or SCF, back into these new ventures. This SCF is the fuel for the spawning engine. Visual, image of a strong engine with cash flowing into it. On-screen text. FCF, the fuel for growth. As investors, our job is to have extreme patience. Set it and forget it, is the mantra. Ignore the short-term noise, the bad quarterly reports from these new ventures. The only time to sell is if the entire business model fundamentally breaks, or if the spawning DNA is clearly lost. Visual: a clock face with a long hand moving very slowly. On-screen text: long-term patience is key. Section 2. The 5 types of spawners. Visual: section title: The 5 flavors of spawners. Now, Pabrai breaks down how companies spawn into 5 categories. 1. Adjacent spawners. These guys expand into markets very close to what they already do well. Think Starbucks, going from coffee shops to selling bottled drinks and fancy coffee experiences. They leverage their brand and customer base. Visual: Starbucks logo with arrows pointing to coffee pods and bottled drinks. On-screen text: 1. Adjacent, close to home. 2. Embryonic spawners. These guys acquire smaller, early-stage companies and nurture them. Meta Platforms buying Instagram and WhatsApp is a perfect example. They inject their resources and expertise to scale these acquired businesses. Visual: Meta logo with smaller logos of Instagram and WhatsApp being absorbed. On-screen text: 2. Embryonic, acquisitions and nurturing. 3. Cloner spawners. These aren't always the most innovative, but they are masters of the fast follow. They see a successful product and quickly copy it using their massive scale and distribution. Microsoft is a classic example, creating Azure to compete with AWS, or Teams to compete with Slack. Visual: a series of similar products, with one clearly being larger and more established. On-screen text: 3. Cloner, the fast follower. 4. Non-adjacent spawners. This is where things get really interesting. They create or buy businesses in totally unrelated sectors. The prime example is Amazon Web Services, AWS. It came out of Amazon's own tech needs, but became its own massive cloud computing empire. Or BYD, moving from cars to electronics and even face masks. This requires incredible capital allocation skill. Visual: a graphic showing a central core business with arrows pointing to very different, distant industries. On-screen text: 4. Non-adjacent, bold leaps. 5. Apex spawners. These are the elite. Companies like Amazon, Alphabet, Google, and Berkshire Hathaway that can do all 4 of the above simultaneously. They have an unparalleled ability to manage tons of different growth initiatives, making their growth runway seemingly endless. Visual: a pyramid with apex spawner at the top and the other 4 types forming the base. On-screen text: 5. Apex, the master spawners. Section 3. The financial engine and valuation. Visual: section title: The numbers game, fueling the spawners. The financial engine of a spawner relies on 2 things: robust free cash flow, SCF, to fund all these experiments, and a high return on invested capital, ROIC, for each venture. Simply growing isn't enough. The returns have to justify the capital invested. Visual: 2 key terms highlighted: free cash flow, SCF, and return on invested capital, ROIC. The critical metric here is return on incremental invested capital, ROC. This tells us how much return we're getting on the latest money invested. A successful spawner will consistently have an ROIC far above its cost of capital. Visual: a graph showing ROIC consistently above WCC, weighted average cost of capital. On-screen text: ROIC WCC equals value creation. But here's the challenge. Traditional valuation models struggle with spawners. They expect linear growth, not the messy, high failure rate process of incubating new businesses. Wall Street often hates this uncertainty. But for us patient investors, this skepticism can create opportunities. Visual: a chaotic scatter plot of numbers, contrasted with a smooth, upward trending line. On-screen text: Market skepticism equals investor opportunity? We need to pay in. Optionality premium. Think of those other bets at Alphabet or Amazon. They're like long-dated call options. We're valuing the potential for massive future market capture, even if they're losing money now. Visual, a stock chart with a significant upward curve, labeled Optionality Premium. On-screen text, valuing future potential. We also use a modified sum of the parts analysis. We look at the profitable core business separately from the speculative other bets. And we focus on operational cash flow, not just accounting gains on paper. Visual, a pie chart divided into two sections, core business and other bets. On-screen text, modified sum of the parts analysis. A key insight for aspiring investors, finding true spawner DNA early in companies with a market cap below, say, $50 billion, is where you'll likely see the most explosive 10x or 100x returns. Once a company is trillion-dollar huge, those massive returns become much harder to achieve. Visual, a graph showing exponential growth potential decreasing as market cap increases. On-screen text, early-stage spawners equals highest potential. Section 4, avoiding the traps, visual, section title. Spotting fakes and staying the course. The biggest risk is falling for a fake spawner. These are companies that chase expansion for vanity or personal gain, not genuine ROIC improvement. It's better to miss a real spawner than to invest in a fake one that destroys capital. Remember how GE and IBM lost their way. They lacked that core cultural discipline. Visual, a company logo with a question mark over it. On-screen text, beware of fake spawners. Genuine spawners are scarce. Finding even one good one a year is a win. We need to do rigorous historical due diligence. Look at 10 to 15 years of their behavior. Do they have a durable cash flow engine? Do they consistently invest wisely? Visual, a magnifying glass over a historical chart. On-screen text, rigorous due diligence is crucial. And remember that patience we talked about? That's your exit strategy. Unless the fundamental business trend turns permanently negative, or the spawning DNA is truly gone, hold on. Even if you have to sell at a loss from the peak, if you benefited from massive gains during the spawning period, you've still done very well. Visual, a handshake over a long-term stock chart. On-screen text, patience and discipline. So, the Pabrai spawner framework is about shifting our mindset from just buying cheap assets today to identifying companies with the built-in capacity for continuous, exponential growth. It requires patience, a tolerance for uncertainty, and a focus on long-term potential. It's a powerful way to invest for incredible wealth creation. Visual, final graphic with the channel logo and social media handles. On-screen text, invest for the future. Like and subscribe.